Sully, you do have to admit that the United States is suffering from a crisis of confidence. So let's bring in our all-star panel on that topic. Tony Fratto is Managing Director at Hamilton Place Strategies. Catherine Mann is a former Assistant Director of the International Finance Division at the Federal Reserve. And Bill George is a Professor of Business at Harvard and also former Chairman and CEO of Medtronic. To all of you, thank you so much for your time. Tony Fratto, let me get to you first of all, because I saw a tweet that you sent out this week which said, "Welcome to the new abnormal." Convince me, if you can, why what we're going through now is different from 2008.
Well, look, the difference in 2008 is we were, really the financial sector was going through an enormous, effort to reprice risk. I think what we're going through right now is a reevaluation of the growth potential of the U.S. economy, and we're asking questions about whether some of the headwinds that we're dealing with right now are cyclical or structural. I think we're seeing a little bit more structural headwinds than we have in coming out of past recessions. Definitely housing, household balance sheets are, very impaired and not getting repaired as quickly as we'd like them to see. And the employment situation, of course, where we have very long-term unemployed that is turning into a structural problem for the U.S. economy.
Well, Bill, if you were running a company right now and you were dealing with a situation like this, you're sitting on a bunch of cash, people are saying, give us some confidence, hire, okay? What would you be doing? You're not going to hire for the good of the economy. You're looking for your business, correct?
Absolutely. And we've created a poor investment climate, and overseas in Germany and in China and Brazil, the climate's and Singapore, the climate's very attractive, and we've got to do this. We have no confidence in our leaders, but I have tremendous confidence in business leaders. Their balance sheets are healthy. They weren't 3 years ago. There's lots of cash, no leverage, plenty of money to invest. The question, where are you going to invest it? You're going to invest it where the opportunities are. We have a flat economy here, and we need to start driving growth in the United States.
Bill, one reason their balance sheets are so strong is because, of course, we mentioned it earlier, jobs. All the layoffs. You've got, what do you do about that? In other words, the companies look good partially because they cleaned themselves up, and that meant laying off a bunch of people.
But that's healthy. That's a good thing. We're getting productivity gains in this country. We've played in a lousy climate for investment. The regulators are all over us. They're stopping Boeing from building a plant that's going to hire 6,000 people, $1 billion investment. The automobile companies are doing great. We need to support them. These are great success stories. But, the administration and even the Tea Party acts like, they love employees and they don't love employers. And the opportunities are there. We've got to get behind investment in America. And I think now is the time to do it because the cash is in the coffers. Companies are doing well, but we have a structural jobs problem. And until we address that, we're talking too much macroeconomics and not at the jobs level.
That's a very good point. Catherine, do you see the crisis of confidence changing, getting better anytime soon?
Well, I think we've taken a pause in the markets. I mean, after all, the markets have been the ones that have been most confident about the state of the economy, in part because of those exact profits that Bill was talking about. Those profits have been earned on the back of relatively little labor, relatively robust international activity, but not in the U.S. So the markets are taking a reassessment about whether or not that's going to continue. Part of what we've seen is something that happens in every August. Everybody in Wall Street wants to close their positions before they go to the beach. And in this type of climate, with this excessive volatility that we're seeing both in terms of the incoming data and the revisions, that means changing our positions quite radically. And I think that's what we're seeing in the last couple of days.
And Catherine, I know you probably couldn't see the graphic. The reason we brought up the two charts, Dow 08, Dow this year, is that they actually kind of looked alike, and some people say, okay, well, the market discounting mechanism is saying that maybe it's a similar situation. But as Bill George noted, there's a lot fundamentally different. What's your take? Is this 08 again?
No, I don't think it's 08 again, because there is something fundamentally different about how the large players in the economy are operating. Both the financial large players and the non-financial large players have been doing very well. They've been restructuring their balance sheet in the case of the financials, and they've been strengthening their balance sheets in the case of the large Fortune 500 type in multinationals. But what is the same from 2008 is the state of the rest of the economy. It is there was a comment about Main Street roaring. No way. I mean, Auto Alley might be feeling a little bit better, but Main Street wasn't roaring then. It's not roaring now. And Wall Street's kind of catching up to the fact that the rest of the economy has not been doing as well as they had hoped.
Catherine, Bill, and Tony.
Let me add on to that. Can I add on to that?
Real quick.
I think Catherine's made some very good points. But, you know, we had 20 years of great success. Reagan, Bush 1, Clinton. We were generating budget surpluses. You know, we had free trade. Why don't we get behind these things? There's $1 trillion sitting overseas in corporate coffers. We could bring that back here with the bargain that if you invest in factories in the United States, you invest in hardcore things in the United States, you get that, bring that money back with a tax holiday or a very low tax rate. There's a lot of things we could do.
Bill, we made that bargain in 2004. You guys brought back the profits, and you didn't invest or create a single job here. And we might also remember that Reagan raised taxes and Clinton raised taxes in order to obtain those budget surpluses. So I think we have to remember what kind of bargains were made back then and what kind of economy resulted.
Excellent
but
debate.
I'll take those tax rates. I'll take those tax rates. And we didn't make a bargain that they had to invest. We just said bring it back. I'm saying put a criteria in there, and you'll see the money coming back. It's there right now. I'll tell you, every CEO I've talked to, a lot of them recently, knows what to do.
I love the debate. It's fantastic. And thank you so much for joining us today.
Thanks,
well,
Mandy.
it is always darkest